In today's episode, we're going to cover how to protect your money. Welcome to episode 3 of the Financial Coach podcast. My name is Mark Corkery and I'm the Financial Coach. In episode 2 of the podcast, we looked at how getting to know your money was the first step in the financial success path. So the next step in the financial success path is knowing how to protect your money. So what do I mean by protecting your money? In understanding how to know your money, we examined your income, expenses, assets, liabilities, debt management and goals. So let's assume for now that you have every one of these areas of your finances under control and you're starting to save some money towards your goals. Well done, you are more financially organised than 75% of the Irish population. So life is great. What could go wrong? Well, unfortunately, the main things that can mess up a fantastic financial plan are illness, disability or death. Most adults have reasonable life cover to cover their mortgage debts, but the majority have minimal protection cover in place to replace their income in the event of death, illness or disability. If I was to ask most people between the ages of 30 and 45, what is your biggest asset? 99% will probably say their home or home and pension fund, if they have one. The reality is your biggest asset during your 30s and 40s is your ability to earn an income. For example, someone who is 30 and earning $40,000 per year, indexed at 2% for inflation until age 65, will have earned just over €2 million. Your ability to earn an income is often referred to as your human capital. In your 30s to your late 40s, your human capital is usually higher than your financial capital or savings and investments. So, if you died or were unable to work due to illness or injury, how would your family recover from the loss of your income asset? Even if we take into account a possible state widow's pension or invalidity pension until age 65, your family will still have lost 1.5 million from your loss of earnings. When you think about it, we all have no hesitation insuring our house, our car, and even our mobile phone. But a significant cohort of the Irish population do not have income replacement protection cover in the event of death, illness, or disability. I mentioned earlier that most people have some form of life cover to cover their mortgage. However, statistically, the risk of a 30-year-old couple dying before 65 is just 8%, but the risk of being unable to work for a month during this time is 80%, and the risk of suffering a serious illness between 30 and 65 is 25%. This information is sourced as a guide from the Aviva Risk Calculator, so you can assume from this estimated statistical data that the risk of suffering a serious illness for a couple between 30 and 65 is 3 times higher than the risk of death for the same period. So now that we have established that the loss of your income can put even the best financial plan into disarray, I want to introduce you to items that you need to understand when you want to protect your family from the effects of losing your income. The first area I want to look at is living benefits versus benefits on death. Living benefits are just as they sound, protection benefits that can be enjoyed by the policyholder while he or she is still alive. Benefits on death. The major difference between living benefits and death benefits is in the beneficiary and the period of maturity. Living benefits pay insured benefits to insured while they're alive, but death benefits are available after the insured has passed. Some examples of living and benefits on death are as follows. Living benefits are income protection, specified illness cover, accelerated illness, and executive income protection. Benefit on deaths are decreasing term assurance, pension term assurance, whole of life cover, and executive pension term assurance. The second area I want to cover is how much cover do you need? In the event of your death, you should have life cover in place to cover your debts and replace your income. To repay your debts, life cover should be in place as either level term or decreasing term to cover your debts. To replace your income, you can calculate how to replace your income by one of the following methods. Multiply your net income by the number of years to your proposed retirement. This is not very accurate and doesn't take account of inflation. Or use a life calculator that takes account of inflation to assess your replacement income. Or the final option, take out a fixed monthly income policy. This doesn't require any calculations. The third area I want to cover is prioritization and risk check calculator. A lot of time, protection products are purchased because we have to buy them. For example, our bank insists we take out mortgage protection insurance to cover our mortgage in the event of our death. If you have the financial capacity to spend more money on protection products than the basic request of your bank, you now need to prioritize your budget over several protection products like life cover to replace your income, income protection cover, and specified illness cover. When trying to prioritize the additional protection products, you should try to consider the risk of any of these events actually occurring. Currently, Aviva have a risk calculator which, based on your personal circumstance, tells you the percentage risk of the likelihood of certain events happening to you before retirement. The calculator shows the percentage likelihoods for death, being unable to work for a month or more, and the risk of suffering a serious illness. If you use this calculator, it may help form your view on where to increase your protection cover. The fourth area I want to cover is price versus features. While you will want to get the best price to meet your budget, it should not be the only consideration, as most life companies may do price pledging. Price pledging helps where one life company will match the price of another company. If prices are the same, you should consider features. Each life company may offer slightly different features even though the price is the same. You should ask your broker to present the different features so that you can pick the features that best suit your personal circumstances. The fifth area I want to cover is the types of protection policies. The first protection policy type is decreasing term assurance. Decreasing term assurance pays a lump sum if you or anyone covered on the plan dies. With this type of plan, your life cover amount will reduce each year. The cost of this cover is cheaper than term or whole of life cover. This is often because the cover may have been chosen to help provide an income for your family, and the number of years you need that level of replacement income reduces as you get older. The other reason for choosing this type of cover is to provide life assurance for a mortgage, as the amount on the mortgage tends to reduce over time. The second protection policy type is term assurance. Term life assurance or term protection is over an agreed term. If you die or become ill during this term, your family will be provided for financially. It can give great peace of mind to have this cover for your key working years, when you may have dependents who rely on your income. The premium is guaranteed, and you may be able to get two different types of policy payments. Number one, level term cover. This means your family will receive a one-off payment should you die during the term of your policy. Your dependents could use this to live on for a period of time, or it could be used to pay for substantial costs such as childcare, college fees, or medical bills. And number two, there's monthly income cover. This cover will provide a guaranteed monthly cover from the time you die until the end of the policy term. The third protection policy cover is pension term assurance. This is a life insurance you start before you retire. It covers you for a specific amount of time which you decide. It pays your family a lump sum if you die during the term of the plan. The advantage of pension term assurance over other life insurance plans is that it usually costs less, because you can claim income tax relief on your payments. The fourth protection policy cover is income protection. If you have income protection, you will receive a regular income if you are unable to work due to ill health or disability. In order to receive the payment, the illness or disability must last longer than the deferred period under the policy. This means there is an initial period of time which must pass when you are suffering from an illness or disability so that you are unable to work before the benefit will become payable. The fifth protection policy cover is specified illness cover. Specified illness cover, sometimes called serious or critical illness cover, provides you with financial support if you are diagnosed with a serious illness. It protects the well-being of and provides a lump sum payment to your family if you are unable to work. It provides a tax-free cash lump sum to you if you are diagnosed with a specific serious illness. It covers a range of illnesses, and gives you time to focus on what really matters, getting better. The sixth protection policy cover is whole of life cover. Whole of life cover is an insurance plan that lasts for a whole lifetime and is not limited to a specific term. If you pass away, this policy will provide a lump sum payment to your family. This plan can also be used to protect your loved ones from the burden of inheritance tax. So, in episodes 1 and 3, we have covered how to know and protect your money. If you can put in place the ideas from each episode, you will be in a great position to plan for your financial future. Thanks for listening to episode 3 of the Financial Coach podcast. See you in the next episode.